Hey everyone, thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin and we're going to be looking at the risk metric. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, this risk metric is something that we've been talking about on this channel, in fact, since 2019. And so far, it has stood the test of time. That doesn't mean that it always will, but so far that it has. What I mean by that is it's never really deviated outside of the bounds suggested by the risk bands, okay? And even at times when it seemed like it was going to, like in early 2021, it ultimately topped out at around that 0.9 wristband, that highest wristband, just like it did in 2017 and in 2013 a couple of times, and also in 2011. The general idea behind the risk metric is to scale into the market at low risk levels and to scale out of the market at high risk levels. But there's sort of a caveat to it, and that's that we never can know where the bottom is, and we can never know where the top is identically. There's no way you can know exactly what the price is going to bottom out or top at. And so the idea is that you could scale in to an asset when the risk level is low and scale out of the asset when the risk level is high. Now, a lot of people, I think, are quite comfortable DCAing into the market, right? They're quite comfortable with doing that, especially with Bitcoin as it has stood the test of time for more than one cycle. But what they're also not generally comfortable with is DCAing out of the market at high risk levels, right? So everyone's okay just sort of throwing money in, but then when people want to sell, they just basically want to sell everything, right? The problem with selling everything, that unless you just get lucky and time the top exactly, if you sell everything and then the price goes up another 20%, you can feel like you're getting left behind. Or if you don't sell anything at any point and you watch the price drop 80%, then that can make you feel pretty bad too. In the same way, if you're at a low risk level and you start buying and you throw everything in and then the market crashes 50%, like in 2018, then you could feel pretty bad about that if you didn't save any of your money to put in at low risk levels. So the idea is to scale in at low risk and to scale out at high risk. Now, in this chart, blue is low risk and red is high risk. We can take the color out of it and just put it as a risk level right here. And one of the things you'll notice is you have these risk levels over here on the y-axis, the secondary y-axis. And the general idea is that you pick a risk level, and below that risk level, you buy. Between a certain level and then another level, maybe you don't really do anything. And then above a risk level, perhaps you start selling. My tactic or my strategy this cycle, again, I talk about this more so on ITC Premium, but my strategy was to get some Bitcoin below 0.4 risk, but then between 0.4 and 0.6, I don't really do anything, right? Like I just kind of sit on my hands and let it do its thing. I'm not buying Bitcoin above the 0.4 risk level, but I'm also not necessarily selling it if it's only around 0.5 risk or something, right? For me to be an interested seller, it has to go above the 0.6 risk level, which is where we are right now. Now, that doesn't mean that I necessarily go out and sell all my Bitcoin, right? I actually haven't sold any yet. But the point is that you can always you can always look at the chart and see what has historically happened after we've gone above the 0.6 risk level, right? And there's several different places you can look. There is late 2020 and early 2021, and you can see we ultimately went all the way up to the 0.91 wristband. And then you can see that in 2017, we did the same thing, although after passing 0.6, while we went up, we then came all the way back down, to less than 0.5 risk as well. So in 2017, it wasn't a smooth journey to get to one risk to the highest risk levels. In 2020, it was basically just straight up for the most part. Same thing in 2013, more or less same thing in 2011. But you'll also notice that there are instances. I guess there's at least one instance, 2019, where we had a rally that went above zero point 0.6 risk, but it didn't actually continue that rally, much beyond that. And if you actually look, I mean, I know it says the high here was 0.645 risk back in 2019, but that was on like the daily close. I believe on the wick to the upside, it actually went all the way up to just below 14K. Right? I think just below 14K. So, basically what I did back over here in 2019 was I sold a little bit in that area, but not a lot, honestly. Not a lot, because I was always more interested in these types of moves, right? So my rationale for doing that back in 2019 was basically just to say, all right, I don't know if this is the rally that's going to take us to the highest risk level, but if it's not, we are above 0.6 risk, it might make sense to take some profits. On the other hand, I didn't really sell a whole lot because I was worried that, well, what if I sell my entire stack and then it just continues to go all the way up, right? So it's a hard place to be at. And really, no matter what you do, you're going to have, there's a good chance you would have regrets, right? So like if you imagine in 2019, if you sold a little bit and it then did what it did, right, your regret probably would be that you didn't sell more. Whereas if you didn't sell anything, you probably would have wished you sold something. And if you sold everything and then the price just kept going up, you would have felt bad about that. So again, it's full of emotions and all that sort of stuff. Trading, it really does elicit a lot of emotions. And so the only thing that I've ever done is just say, all right, above a certain risk level, I scale out. Below a certain risk level, I scale in. I know on the channel we talk a lot about potential short-term price action and what are those expectations. But as I've said before, I don't trade any of that stuff. I don't trade any of the cycle theory stuff. As I've said, I just trade based on what the risk level is. The risk level for me tells me if it's a high risk time or a low risk time. Sometimes it can feel like a high risk time when it's really not. And then other times it can feel like a low risk time when it really is a high risk time, And so I think that is the reason that using a risk metric or something like it can be useful. And again, you don't have to use this one. There's all sorts of risk metrics out there that you could use. You could always create your own. There's a lot of different metrics that you can find to use. And I would suggest just finding something and sticking with it throughout the cycles. There's a lot of great indicators out there that you can use. But this is the one I use. And so, the idea, again, is to scale in below a certain risk level and then to scale out above a certain risk level. That's the only thing. The reason I don't just say set a number and then below it buy and above it sell is that sometimes you get this sort of price action where it goes above it and then below it and then above it and then below it. And I'm not really in the business of like buying and then selling like 2 months later, right? Or selling and then trying to buy it back 1 or 2 months later. There's a lot of traders that do that, but that's not really my style. My style is more so just buy some Bitcoin at lower risk bands and then sell it at higher risk bands. So I did accumulate some Bitcoin over here. I posted those buys in ITC Premium. Honestly, I did not accumulate as much as necessarily I would have liked, but I still did accumulate some. But I will tell you, I mean, throughout all of my time in crypto, the best problem to have is wishing you had bought more, right? The worst problem to have is wishing you hadn't bought so much. And I think we've all been in both of those scenarios before, right? Where you either bought too much and you regret it, or you feel like you didn't buy enough, okay? So it's a much better feeling to feel like you didn't buy enough than to feel like you bought too much. Because when you feel like you bought too much, that can be extremely detrimental. Especially if it's on the eve of like an 80% drawdown in the market. So I think this is a useful metric to look at. The other thing to consider though as well is that historically, once you get above zero point 0.6 risk, which is where we are right now, it's not that much longer before things come back down. That doesn't mean they have to come down from this level, right? But typically, once you cross zero point 0.6 risk, the time is ticking on how much longer this move has before a pretty big cool off period. You can see, like in 2020, once we passed the zero point 0.6 risk level in December, we went up, right? But then we collapsed all the way back down to, to less than 0.4 risk about half a year later, right? I mean, I know half a year might sound like a long time, but in the grand scheme of some of these moves, it really isn't. I mean, some of these moves lasted years, right? This move over here lasted years before it really durably got above 0.6 risk. And then you can see in 2013 when it got above 0.6 risk, it got above 0.6 in November, and that was when the market topped out. Maybe December, maybe sort of the end of December. Although I think the actual highest price came in November, and then we actually had a lower high in December. And then over here, right, when it passed 0.6 risk, you can see that it ultimately topped out basically within a month or two. And then same thing in 2011. The longest period of time after durably passing 0.6 risk, and maybe it's not even that much longer, about half a year, right? So in this cycle, you had about half a year. In this one, you had about half a year. But in these three, you only had about a month or so, right? You only had about a month. So 3 examples, you have a month. 2 examples, you had 6 months. And then there's one other example, which would go with these 3, where you basically had a couple of weeks, right? And in that case, we didn't even go all the way up to the higher risk bands, right? Like we basically just topped out between 0.6 and 0.7 risk. I think it went to about, on the daily, it went to 0.645 risk, but on the hourly, it went to about 0.68 risk. And again, right now we're at 0.613. If I were to pull up the Bitcoin risk levels, right, just for reference, so like 0.625 risk is at 45K. 0.65 risk, which is around the highest daily close we had in 2019, was around 48K. 0.675 risk is around 51. And then around 0.68 risk, which is, I think, the highest it went in 2019 on an hourly move, today would correspond to around 52K. So, right, it really depends on how high it goes. And I mean, you can see how high the risk levels ultimately go, but there's no way to know if we make it there, right? There's no way to know ahead of time if we're going to go all the way up or if it just sort of fades before then. In 2019, I distinctly remember, there's a lot of really bullish sentiment back then too, and then it somehow just died out, and actually it died out just before the Fed started to cut rates, in fact. I remember it because, I remember the Fed cutting and the S&P kept going up, and then crypto basically faded at that point, which I thought was interesting. But I think this is an interesting chart to look at. The other thing that you can look at is the time spent in the wristbands, right? So like when you look at this chart and then you understand like where we are right now is in the 0.6 to 0.7 wristband, as it says, you can see that in the grand scheme of all prior history for Bitcoin, it doesn't spend that much time between 0.6 and 1 risk, right? It spends a majority of its time over here. The wristband that we spend the most amount of time in fact, is between 0.3 to 0.4 risk. That's where we spend the most amount of time. Then after that is 0.4 to 0.5, and then after that would be 0.2 to 0.3, and then after that is 0.1 to 0.2, and then it goes all the way up to 0.5 to 0.6 in order of where we spend the most amount of time. The 2 risk levels that we spend the lowest amount of time are between 0.8 and 1, and then after that you have the 0.7 to 0.8, and then also the 0 to 0.1, which is hardly ever seen. So when I look at this chart, I just sort of we have to remind ourselves, right? Like these times are nice in the sense that like you're seeing your portfolio go up, and again, there's no way to know how long it's going to last. And I'm not going to sit here and try to pretend like I can tell you. I don't know. But you can at least look at the context of history and see what ultimately happened. One way to visualize it better, perhaps, is to only isolate the 0.6 to 0.7 wristband, right? So when you look at it like this, what do you notice? You can see like in 2020, we actually, after we hit it, we then went up a lot higher into that highest wristband. 2019, it was these couple of weeks after getting into this wristband that marked the top. 2017, we had a few months of it. 2013, it was basically just like a couple of weeks before that move was over. Same thing in 2011, right? So again, there's no way to know if it's going to go all the way up or if it's just going to sort of fall out at below, those higher wristbands. You can also just isolate the highest wristbands as well, like let's say 0.8 to 1, and you can see kind of where those fall in line. So here's the thing, like imagine in 2019, you loaded up on Bitcoin over here with the intention of selling at the highest wristband. You watched it go up 3 to 4x, and then it just fell back down, right? And perhaps some people bought over here, did not sell, and then capitulated on this low, thinking that we were going to go into a long, drawn-out recession when the pandemic hit. But you can see we didn't. I mean, we went up, we did not go to the highest wristband, we then came back down, sort of double-checked that this was the low, and then we went up. If you were to look at the lowest wristbands, right, you have the 0 to 0.2, this is what it looks like. So I think it's useful to sort of think about how to navigate these markets. It's always hard, especially in the moment, especially like on days like today when it just seems like the market is sort of just screaming to the upside. But again, what I do, I just DCA in when the risk level is low. I DCA out when the risk level is high. I honestly don't make it any more complicated than that. And I've done several videos on this topic, and I say that every single time, right? If you go back and look at all the videos that I've previously done on the risk metric, that's what I've always said. I just use the risk metric to DCA in when it's low and then DCA out when it's high. And then I think a lot of people get surprised by that, but they'll be like, well, what about this move that you thought might happen? Yeah, I mean, I can think all sorts of things, but what I do in my portfolio can be quite different. Now, if there is a drop, right? If there is a drop, then you would look towards those lower wristbands. If we just keep going up, then I would be looking to see when those higher wristbands ultimately get hit. But this, I think, is a decent way to sort of think about it. And one way to navigate it is to think about exit strategies, right? So like you could say, all right, well, let me think about what the peak price for Bitcoin will be. You could then enter it in. You could say projected peak price. I don't know. Like you just pick a number. Let's just say 60K. And you can then pick a strategy like, do you want to be conservative, moderate, aggressive, the hodler, YOLO, or Sea of Tranquility? The Sea of Tranquility idea is the person who doesn't sell anything until the highest wristband, and then they just sell it all, right, at the top. The person who can time the top exactly, and they basically sell their entire Bitcoin for that top price. But if you are like me and recognize that it's impossible to pick the top, then the idea is you start scaling out at a risk level you're comfortable with. Now, the trick here, and I see this on Twitter, is like everyone says, well, there's no reason to do this or there's no reason to do that. But in reality, investing is a personal journey. What's right for you is probably not what's right for someone else. And I think we have to respect that, right? Like, if someone wanted to start taking profits at a low wristband because they needed to use that money to go pay for some type of, I don't know, like big expense, like a house or a medical procedure, right, or something like that, like, it shouldn't be the, sort of the peanut gallery's job to make them feel bad about taking profits even at lower risk levels, right? You shouldn't do that because you don't know why they might need to do that, right? Some people just don't want to take on more risk. Whereas other people, would say, well, to hell with taking profits, you know, um, why not just hold on and hope for the best? Like, just hold it until, as many years as you can, and then think about taking profits if you want. And then sometimes people make them feel bad about that. But why should you? I mean, the younger you are, if you want to take on more risk, then that's up to you to take on, right? So there's not a right answer, right? Like, there's not a right answer. And that's the hard part, is that there's really not a right answer. And if you tell people what you're doing, then they'll, of course, they'll come up with a reason why that's the wrong thing. But just because it's the wrong thing for them doesn't mean it's the wrong thing for you. So, in this case, like if you wanted to say go the aggressive strategy, then it means you would start to slowly scale out at the 0.7 risk level, right? If you wanted to go with a moderate strategy, it would mean starting to scale out at the 0.6 risk level. And then you have, this is like an exponential strategy where the first band is Y, and then you double it. Here's constant, which is basically selling the same percentage at each risk level. Here's linear, where you go Y, 2Y, 3Y, 4Y. So you're just basically dynamically increasing it. And then there's the exponential, which is where you're doubling it each time, right? So it would basically mean like if you started selling at the 0.7 like the 0.7 risk level, you would sell a really small amount. But then if it went higher, you would want to increase that, right? And so on and so forth. So by the time that if it went all the way up to the 1 risk level, you made some money. Now, what do you notice about this strategy? Let's go look at the linear strategy. What do you notice about following, say, like an aggressive strategy versus just being the person that times the top? The funny thing is, if you follow something like this, there's a decent chance that the person following an aggressive strategy, which is more conservative than the Sea of Tranquility strategy, right? This person who timed the top made 60K. The person who started taking some profits still made 50K, right? So like there wasn't even a huge difference in the end between the person that timed the top perfectly and the person who started scaling out. And the person who started scaling out at least had the benefit of knowing that if the rug got pulled at any time, they at least took some profits. The person that timed the top exactly could have been stressful because every single pullback you're wondering, oh crap, did I miss it? And is it about to collapse? So again, it depends on what your strategy is and how risky you want to be. You could also change the projected peak price. Like maybe you think 60K is too low and you want to put in 100K, right? And then you can see what it would correspond to. Or maybe you think everyone's too bullish and you just want to put in, 46K or something and see what it does, right? So there's all ways that you can sort of navigate it and come up with a strategy. And again, I'm not saying you should use this strategy. I'm just saying it's often useful to come up with a strategy. Because if you don't have any strategy, then what happens is, you just buy, and then everyone is so bullish and anyone who says anything bearish is sort of immediately ganged up upon and ridiculed and all that stuff. And then before you know it, the market's down 50%. And then those guys that were screaming buy, now they're just saying buy the dip right after it's down 50%. So again, it's a hard game to play because no matter what you do, you're going to piss someone off, especially if you publicize it. So that's why I don't often say what I'm doing, right? I talk about the markets as best as I can. Sometimes I get things right. Sometimes I get things wrong. That's the way the market works, right? I mean, no one's going to have a perfect batting average. I sure as hell don't. But that's my strategy, right? And it's never been more complicated than that, and I don't plan on ever making it any more complicated than that. Just slowly scaling in at low risk, slowly scaling out at high risk, talking about potential paths along the way, but also saying, you know what? Like I can't predict exactly the way the price is going to go. And I guarantee you in 2019, if you go look at what people were saying back in July, most people were not bearish, right? And most people were not bearish in March of 2020 either. I mean, everyone was bullish. The hash ribbons had printed, the buy signal, right? Everything seemed good to go, and then everything collapsed, right? So there's just no way to know, right? You don't see big drops when everyone's bearish usually, right? It's usually when everyone's bullish, but the sort of the mania times, as we showed earlier, can last, a month after hitting the zero point 0.6 wristband, which we're at now. And there were 2 instances in the past where it lasted about 6 months, about half a year. So I can't tell you what's going to take place this time. I think you could come up with a compelling argument either way, right? I think you could. I think the compelling argument to say that it would only go for another month or two would be to say that, like, all right, well, if the spot ETF gets launched and there's not as much volume as people are initially thinking, just like some of the stuff we saw with what was launched with Ether not too long ago, then it could be a sell the news event. But then you also have the people that are saying that it's not a sell the news event, and they're pointing to like what happened when the gold spot ETF was launched, and you saw what happened there. You also have the Bitcoin halving coming up in April, which is another event that you could, that the Bitcoin might look forward to. So again, and as far as like saying only another month or two, I think another case for that will be to say, well, what happens if we get into the new year and the economy finally starts to slow down, right? I mean, at this point, I know no one even cares about that stuff anymore, and I mean, I don't necessarily blame you, but after yield curve inversion, it often takes 12 to 18 months to see those lagged effects take place, which is what we're coming up on. But the counterpoint to that, to the person that thinks it can go another 6 months before slowing down, 5 or 6 months, would be to say, well, there were a lot of people that called for a recession in 2023, and look at where it is. So who's to say that it won't, even if there is a recession, who's to say that it won't be in the second half of 2024, right? So, I mean, you could come up with compelling arguments either way. Again, the truth is no one knows. None of us know. And so I think you should have a strategy either way. And again, for me, as I've said, this cycle, I scale in below 0.4 risk. I scale out above 0.6 risk. The way I normally do it is just like with limit orders, right? So like if the rug gets pulled, something gets filled, rather than nothing and watching it just go collapsing back down. And then the same way when we're at low risk levels, I basically just set limit orders and hope they get filled. And sometimes basically what happened this past year is I filled some between 15 to 21K. And again, this was published in ITC Premium. I had also a few set below 15K. I think I had some set at like 13K and 14K and so on and so forth. Those did not get filled, right? But the ones between 15 to 21K were filled. So when I said like it would have been like I bought some, but I didn't necessarily buy as much as I would have liked, that's because some of those limit orders were not actually filled. Only some of them were filled, right? Only a few of them were filled. The others were not filled. But it's the same thing when price is going up, right? Like, I think we can all imagine a scenario where people just think it's going to go higher and higher and higher. I mean, no matter how high the price goes, there's always going to be a large group of people that's going to think it's going to go higher, right? And the people that come in late to the party, those are normally the people that get burned, right? When there's no one really to come after them and to keep supporting the price in the short term, and then the market basically just gets rinsed. So just remember that, right? Remember that. So again, this is the risk metric. Again, you can get access to this through the website, intothecryptoverse.com. We do have the sale going on. Make sure you guys check it out. Again, if you don't want to use this one, I think that's completely fine. Just come up with something, right? Come up with something. There's plenty of different metrics that are out there already in the Cryptoverse that are free to use, free to follow, and I think it's worthwhile to follow those. And then there's also a lot of great analysts, I think, out there in the Cryptoverse that people should be following. And I would encourage you, honestly, to follow people that have very differing views, is what I would say. Because if you don't, then you can essentially get stuck in an echo chamber where you're only hearing one person's views and you don't hear another side to the story, right? But we're in a market, and no one person's opinion is going to dictate what that market does. So in order to get the best idea of possible outcomes, I think it's useful to follow an array of people that range from super bearish to super bullish to then everywhere in between. And normally what happens is the super bearish predictions don't actually pan out, and the super bullish predictions don't normally pan out. It's somewhere in between that normally ends up happening. right? So that is what I would say. Make sure you guys do that. Again, sale to the site is going on right now. You can find a link to that in the description below or the pinned comment. Thank you guys for tuning in. Subscribe, give the video a thumbs up, and I'll see you guys next time. Bye.